Hello everyone, and welcome to the Financial Prophet. Today, we're going to discuss something really special. We're going to talk about why American exceptionalism is back. Well, it never really went anywhere. Many people just started doubting it around the time and after April 2nd. However, America is clearly back. There's been a lot of talk about America losing its so-called exceptionalism, especially after the April 2nd Liberation Day meltdown. The buck has dropped by over 10% since its highs around 110 early this year. Now, isn't this a problem? Some people ask. This dynamic has even led some people to speculate that the US dollar could lose its reserve currency status. Now, I personally don't agree with this. I simply think the dollar was too high recently, and around 100 is an excellent long-term range. Granted, there was a great deal of pessimism and volatility going into and around April 2nd. However, I believe that the dollar has stabilized and is in a much healthier place now than it was then. There's also been considerable discussion about declining demand for U.S. assets in general, like stocks and treasuries, corporate bonds, and more. Well, I'm not so sure about that. U.S. stock indices have made enormous recoveries since the April bottom. There seems to be pretty robust demand for high-quality U.S. stocks here, as major stock market averages are around all-time highs again, which is remarkable given that we were down so much in April and we've made essentially a full comeback in just about 2.5 months. In fact, the S&P 500 has made one of the most dramatic recoveries in stock market history, appreciating by a staggering 28% in just about 2.5 months. Now, although the S&P 500 and the NASDAQ 100 are both around their respective all-time high, the NASDAQ 100's recovery has been even more stellar. The NASDAQ 100 has surged by a remarkable 38% since the April 7th bottom, and it just hit about the same level it was trading at before the winter drop began. Now, this dynamic again illustrates that U.S. assets are in very high demand, especially high-quality stocks. Now, let's take a look at the 10-year Treasury yield here. So the 10-year and Treasuries in general received a lot of attention when yields rose instead of dropping as the early April tariff-related panic-driven sell-off peaked. While this was very concerning at the time, bond markets appear to have stabilized for the most part. Also, the irregularities witnessed then in the bond market may have been caused by a combination of China selling some treasuries, the Chinese government, CCP, April tariff-related panic-driven sell-off. When it peaked, we witnessed a lot of selling. So it was probably China selling, but in addition to this, we probably also witnessed the unwinding of some leveraged speculative bets in the bond market. But, we need to consider that we also have the Fed, which can essentially buy as much treasuries as needed, creating artificial demand in the treasuries or the bond market or just about any kind of market that the Fed feels it's necessary to step into and kind of provide a helping hand. I know that Fed Chair Powell hasn't been that accommodative, especially recently. However, the Fed was doing stealth treasury buying very recently when there were problems in the bond market. Around the April lows. Moving forward, we can probably expect the Fed to do more, especially when a new Fed chair gets appointed next year. We can probably see a good deal of treasury buying, bond buying, mortgage-backed securities buying, and other, basically any kind of assets that pose a risk to the financial system. We could see quantitative easing, I believe, in 2026. Okay, so moving on to investors wanting to exit the U.S. Now, it was pretty remarkable to me, but I had many investors approaching me in April seriously debating if they should divest considerably from the United States. Many people appear to be contemplating this as a potential long-term strategy and investment approach, not just a near-term kind of risk-off strategy, but people really appeared to be losing faith in American. So my answer was always very clear and simple. You should not divest from high-quality U.S. equities. Instead, you should probably aggressively buy every significant dip that you can. After all, where are you going to get to invest instead of America? Now, I also put my money where my mouth was. I increased my high-quality equity exposure considerably on April 7th, adding approximately 30% to my stock and ETF portfolio. I also increased a few days after that on April 10th as the market essentially retested the bottom. And after that, stocks, they basically just took off. These two substantial adding periods are primary reasons why my portfolio's outperformance has been so significant. Without my unwavering conviction in the US and its future, I may have sat on the sidelines or may have just, dumped my stocks around the bottom, as I think a lot of people actually did, unfortunately. In any case, without the April 7th and 10th additions to my portfolio, it would still be outperforming the major averages, but nowhere as much as it is outperforming now. My all-weather portfolio is at 33% Q to date and at 22% year to date now. And it's really all because of just 3 words. So why we want to invest in America? 3 words: military, economy, and innovation. Number 1, military. Did you see that strike on Iran's nuclear facilities? I mean, talk about surgical precision. I truly believe that no other military in the world could have done what the Pentagon did, especially so seamlessly and effectively. America is still by far the most advanced and capable military globally. This does not mean that America needs to solve all the world's conflicts or be the global policeman. Nonetheless, projecting unrivaled conventional military power and nuclear if needed, it really goes a long way and is one of the reasons why America remains exceptional. Also, don't be fooled by China. While the CCP projects, quote, so-called strength by threatening Taiwan and bullying its much smaller neighbors, it is nowhere near the US, militarily wise. China is a paper tiger, and its military is at least 20 years behind the United States. Now, other sources like the State Department, they say that the Chinese military is actually about 30 to 40 years behind the United States. Now, that's the official view of the United States State Department. And I actually believe this is more accurate than the 20 years estimates. Now, the only real serious military rival to the United States is actually Russia. And it's not because of its conventional forces, it's because of its highly advanced and massive nuclear arsenal and very advanced rockets and delivery systems. Still, when it comes to just basic conventional global military capabilities, America is the sole global superpower, and it may remain so for a very long time. Number 2, economy. America's economy is very unique in that it is by far the most significant consumer economy globally. It is, in a big way, the engine that continuously drives global growth. The U.S. imported about $4.1 trillion worth of goods and services last year alone. Now, in comparison, the EU, which has a more significant population, imported about 2.43 trillion euros worth of goods and services last year. Now, that is a massive difference, and please keep in mind that the EU's population is at about 450 million, while the United States population is only at about 340 million. Now, let's do a little math here. The average exchange rate was about 1.07 last year, in dollar euro terms. So in dollar terms, the EU imported about 2.6 trillion in 2024. Therefore, the per capita import in the EU was about $5,777 versus the per capita import of roughly $12,060 in the United States. Now, really, that is a massive difference when we look at the world's 2 most advanced economies this way. Okay, so moving on to per capita GDP. There is also no real comparison here, as the US's average was about $86,000 last year versus the EU's 40,000 euros, roughly a 100% difference. So I read an interesting fact today. Now, I have nothing against Europe. I live here. But the Union's, America's, quote, poorest state, Mississippi per capita GDP was about the same as Germany's in Q3 of last year. So the US economy is quite exceptional in this respect and in many others. Now, let's move on and talk about innovation, which is number 3. There is no innovation like in the United States. I love America. And I love Europe. I was born, on the European continent. I spent most of my life living in the United States, though. Currently, I live in Europe again. Maybe I'll live in America in the future again. It's very possible. I've been around the world a bit and I've seen many fascinating things. Still, I'm always going to be honest, and innovation wise, there really is no comparison when speaking about the United States and the European Union. Maybe it's the high taxes, the more traditional culture, or possibly it's because of the more laid back lifestyle in many European countries. But Europe's most considerable recent innovation may be the plastic water bottle cap that stays attached to the bottle after you open it. You may think I'm joking, but I'm actually not. At first, I did not care for this innovation too much, as I was very accustomed to the bottle cap, disconnecting completely when opening a water bottle. Nonetheless, I have to say that I've grown to appreciate the bottle cap that never falls off and stays attached to the bottle at all times. So, I'm using this innovation. I like it very much. I drink a lot of water. I'm very grateful for it. But, is it like advanced semiconductor innovation or AI? No, of course it isn't. And it's understandable because there are no Elon Musks or Jeff Bezos here in Europe. There's no Silicon Valley, and that's fine. It's just a much different kind of life. So you're probably not going to find that many high growth companies to invest in Europe. That's my basic point. So innovation, the United States versus the EU, we can look at the visual here. If we look at public companies from scratch that are less than 50 years old and have a market cap of over $10 billion, the EU literally has about a handful of such companies. There's Spotify and about 5 or 6 other big tech companies that have broken out past the $10 billion mark in Europe, while the US has literally too many to count. So, and this of course includes essentially all the dominant, tech companies that operate globally, the Mag 7 or the Mags, whatever you want to call them. They're all American. So, okay, where else to invest? Now, this kind of goes hand in hand with the, like the best house in a bad neighborhood, I was saying. So Japan, it has solid companies, but where's the growth? Also, Japan's enormous debt and potential deflation, they complicate things. Investing in South Korea is essentially like investing in Samsung. China and other developing countries, they have innovation, but where does China really get a lot of its innovation from? Well, China gets, its innovation from the United States and wherever else it can. Now, I want to talk about why China may not be the ideal place to invest. And don't get me wrong, I really have nothing against China. Although I talk about China, people may think in a sort of negative context, but it's mostly the Chinese government that I disapprove of some of their policies. But I have nothing against China or Chinese companies for that matter. I've owned a lot of Chinese companies. I've owned companies like Baidu, I like a lot. Alibaba is a solid company. I've owned some EV companies in China. Tencent is an excellent company. So China does have very good companies, but China is still not an ideal place to invest. And I think investors have kind of learned that lesson maybe the hard way the last several years as Chinese equities have underperformed rather massively. And there's no guarantee that they're going to outperform as we advance. So aside from China's economy being in pretty bad shape for years now, and its stock market massively underperforming, let's face it, China does not play fair. There have been serious allegations about Chinese IP theft and other considerable infringements. I can provide just a rudimentary example so it can be relatable. So basically, I can formulate it this way. So this is how Chinese innovation works at times and why everything is cheaper in China. Let's presume that I have a company that designs, develops, and manufactures a certain widget. It doesn't matter what it is really. And for the sake of this argument, it can be a really nice webcam holder stand. Let's imagine that I spent money on R&D and on bringing this webcam holder stand to market. It's a relatively nice product, and let's say that I charge $50 for it. As there may be considerable demand for my product, and I want to make a decent profit to support my family and pay my employees well. So here's where things may turn south for me. Unfortunately, once my product hits a certain run rate, which illustrates the potential for long-term success, it can be copied by a Chinese company. The Chinese company can produce an analogous, essentially identical product much cheaper. and they don't have to go through the costly and lengthy R&D and approval process in many cases. Now, they can just basically manufacture millions of copies of essentially the same product that I created. They can then sell this product in China or on the internet right next to my product for cheaper, maybe twice as cheap, and potentially even at a fraction of the price. In full disclosure, I just ordered this quote product, a webcam stand holder, recently from PDD Holdings, stock symbol PDD, the owner and operator of Temu website, which is where I ordered it from, and it cost me €8, which is about $9. Now, I also looked around in stores for a similar product, and they go for about €30, so roughly 4 times the cost of this basically same product. Moreover, if it is a complex or a more costly product to build, develop, and copy, basically, the company may get subsidies from the CCP government, which could potentially help them put me out of business. Litigation is essentially pointless for a small business like my hypothetical enterprise. Now, is that fair? If you think I'm overhyping this, I'm not. Last year alone, Chinese courts accepted over 529,000 new IP cases. So the million-dollar question, where to invest if not in the US? It's actually a rhetorical question, because nowhere. The US remains the best place to invest. I was bullish on America before April 2nd, and I'm even more bullish on America now. I had a 7,000 S&P 500 year-end price target at the start of 2025. Now, the only reason I lowered it to 6,500 is because of the floppy implementation of tariffs on April 2nd, which created a black swan event. Now, on that note, I've been considering raising my year-end S&P 500 target in recent weeks, and my new SPX target range is 67 to 6,800, so about 6,750. Having said that, I believe some stocks may have appreciated too quickly in recent weeks, and there may be a summer pullback ahead. Now, the S&P looks intent on going for a new all-time high here, but I'm still not convinced we have a clean breakout right now. We still have considerable near-term uncertainties regarding trade, earnings, the general well-being of the economy, and the Fed is in no rush to cut rates. Technically, conditions are becoming a little bit overheated here. I mean, we've been overbought for a bit, then we went through a bit of a consolidation phase, which was pretty constructive. Now we're becoming a little bit overbought again. So I'm considering that we should probably, see a pullback in the near term. We need, pullbacks and consolidations in a healthy market. Therefore, we could see some volatility increases over the summer, especially if key economic indicators worsen, earnings or guidance declines, recession fears rise, and sentiment could drop potentially. Despite the near-term uncertainties, I remain constructive on high-quality equities, especially in the intermediate and long term. Also, I plan to increase core holdings on a potential pullback. In my view, it would be a highly lucrative buying opportunity if the S&P 500 corrects to about 58 to 5,700 in the coming weeks. There's an unfilled gap there. It is possible. So I'd like to thank you very much for watching my video. I hope that you enjoyed my profit report. But more importantly, I hope that my video helps you make more informed investment decisions going forward. I would also greatly appreciate hearing your comments, so please join the conversation in the comment section below. If you like this video, please click like, share, and subscribe to my YouTube channel so I can continue creating these highly informative and potentially profitable videos for you guys. You can also join the Financial Profit, my exclusive investment community, which is seeking Alpha's #1 service for proven portfolio profits. So don't hesitate to join our 500 plus member community now. Thank you very much for watching my video. See you next time, and have an amazing day.